in order to accommodate the schedules of people working for the city. Ian, why don't you provide a broad overview, and then we will go into executive session. And maybe before we do that, let me just stop you. The minutes of the public session were distributed prior to the meeting, so everyone should have had an opportunity to review them. Also, I do note for the record that we have a quorum for today's meeting. Can we have a motion to approve the minutes of February 8th, 2023?
So moved.
Second?
Second.
All in favor, aye.
Aye.
Anyone
Aye.
opposed, speak up. If not, the minutes are approved. All right, Ian, it's now your program.
Right. So starting off with a couple observations on the markets. Today, the Fed's going to meet, and the anticipation is that they might increase short-term rates again by about 25 basis points, but that won't be known until about 2 o'clock this afternoon. This particular chart shows the pace and level of interest rate increases back to 1990, and the, I guess, slate blue, the thickest of the bars on the left-hand side, shows the 9 interest rate hikes from March of 2022 to March of 2023, about 4.75% increase in the Fed funds rate. And in history, this is the fastest and steepest pace of interest rate increases that the Fed has followed. And they have done so in order to fight off the impact of inflation that is a result of the stimulus that has been thrown, that was thrown at the market during the depths of COVID. And now we're trying to slow the economy down and put people out of work and stop people from buying goods and services at inflated prices. And that has been challenging over the past year plus. The following page shows the market returns through the end of March. And so I'm just going to look at the year-to-date column. And even with the uncertainty in the markets, we've gotten off to a pretty good start in 2023. And we have positive returns coming from both the equity market and the bond market. The equity market, large company stocks were up about 7.5%. They led mid and small cap stocks as reflected, which were up 4% and roughly 2.75%. The story in 2023 has been the rotation back to the growth style of management. And if you recall, growth led through 2021, but then in 2022, value was the place to be. But we have seen a reemergence of the growth leadership. And the leadership is really narrow. Something like 65% of the S&P 500 return is attributable to the top 5 companies in the S&P 500, most of which fall into the growth camp. But look at the difference in performance between the Russell 1000 Growth Index, which is up 14.4%, and the value index is only up 1% for the first 3 months of the year. We've seen positive results coming from international. The MSCI EAFE index is representative of developed markets like the US, and up 8.5% through March. And the emerging market index was up about 4%. Bonds have been positive because in 2023, yields have fallen. And so you see the investment grade part of the market, the Bloomberg aggregate index was up just under 3%. Investment grade corporates were up 3.5%. high yield bonds were up 3.5%, and global bonds were up 3%. And basically, the bond market has reacted favorably to, I think, just general signs that the government's efforts at trying to curb inflation are starting to take effect. And that has allowed yields to fall and bond prices to go up. We put together a snapshot of performance through April 30. And first of all, quarter to date is the month of April. So that is the second quarter. And so it would be the same if I had the month to date. And you see a positive return for the month from the S&P 500 index, but slightly negative for mid and small company stocks. And when you look year to date, the S&P is now up 9.17%. You've had a little bit of a give back in the international markets on the emerging market side, but still a positive return from the developed markets. And the developed markets are now leading year to date, up 11.5%. And then we've had continued positive results in the month of April, and for the bond market, and a 3.6% return for investment grade bonds, and then 4.6% for high yield bonds. I'm not sure why this box came up. Something, when you look at the history now, and we know sort of the bumpiness that we've experienced over the past couple of years, both on the upside and the downside. But with the most recent positive results, the near-term results are sort of muted. So the trailing 12 months, 1 year, we're down 1% in the S&P 500. Trailing 2 years, we're up 1.4%. Look back 10 years, the S&P is up 12.3%, which is more than 2% higher than a historic average going back of roughly 10% going back to 1926. One thing I like to point out, and I think I did it at the last meeting, is that when we entered 2020, the S&P 500 was at an all-time high at the end of 2021. And the actual all-time high was February 19th of 2020. And since February 19th of 2020 until yesterday, or until actually last Friday, April 28th, April 30th fell on the weekend, the S&P 500 is roughly 30% higher than where it was pre-COVID. And the bond market over that same time period is generally negative. So if leading into COVID, investors said, we want to become more conservative and go to bonds and get out of equities, you would have had basically a negative return. But if you stayed in equities from February 19th of 2020 until basically the last weekend, you would be 30% higher cumulatively. That's not an annualized return, but cumulatively. So we did give back a lot in 2022, but we were up 120% from basically March of 2020 until the end of 2021. The S&P was up just a huge amount. Another takeaway from this chart are the FANG stock. I mentioned this, the FANG stocks and the year-to-date performance. This column here is year-to-date, and you've got a very small number of stocks providing the bulk of the market return. And so you look at Facebook, Facebook's up 100% in 4 months. Why is Facebook up so much? Because they were beaten down a lot based upon their capital spending, the anticipation that they wanted to spend a lot of money on the metaverse. They've sort of changed that tune, and people have found Facebook to be attractive because I think there's a lot of earning and profitability potential with Facebook, and it was at a pretty cheap valuation. But in general, these growthy type names are up significantly relative to the rest of the market in 2023. And this is a chart which I occasionally show.
My favorite.
This shows a lot going on this page, but it shows returns from, let me show the index. So from October of 2007, which was the market high just prior to the GFC, the global financial crisis. And then we had a bottom in March of 2009, roughly. And then we've been in a upward trajectory since then. But every blue part of the chart is what's called a 5% drawdown or 5% loss. And we have little numbers with a hash mark or a slash mark between them. And the first number is the number of days it took to lose 5%. And then the second number is the number of days it took to gain back that 5% and get back to water level. And so a lot of takeaways here is that in general, the market is up more than it's down. This is our more recent period where up in the upper right-hand corner, where we were, at all-time market highs at the end of 2021, the first 9 months of 2022, a bear market environment represented by that blue portion. But we're slowly sort of clawing our way back over the past 6 months or so have been positive. And, if you're going to be equity investors, we preach that you have to be patient. These bumps along the road they're evident. They seem to be more evident in the last couple decades than they were in the prior decades, but they're part and parcel investing in equities, and they require patience. So any questions? Joe, that's my comments on the market environment.
That's fine. Why don't we go into executive session so that we can talk about where we are and where we may want to go? Can I have a motion for executive session, please?
Can I ask a general question first? This is Jody.
Yes.
Ian, how has the last 12 months been in overall recouping the big drops that we saw about a year ago?
The last 12 months, I'm going to go back a page just a sec.
Yeah, and I'm sorry because I'm in the car and I can't look at the charts. So it's a question that's been on my mind. So through April 30th, Jody, if you were looking at, there's one chart that I put in the second email I sent called meeting materials. And we generally have slightly negative results for equities and fixed income. So I'm going to give you a couple numbers. One, large company stocks represented by the S&P over the last 12 months are down 1%. And now, interestingly, the international markets over the last 12 months are up 9.6%. The developed markets, emerging markets are down 4.5%. Investment grade bonds are down roughly 1%, and global bonds are down 2.3%. But if you looked at the last 6 months are positive. We started to see a turn in October of 2022. Okay. Thank you.
Yep. Any other questions?
So I'll take my motion to go into executive session.
Motion.
Second.
Those in favor, aye.
Aye.
Nor is